Welcome to the Top of Mind podcast from Altos Research. This is the show where we talk to real estate industry insiders and experts about the trends shaping the market today. Enjoy the show. Mike Simonsen here. Thanks for joining me today. Welcome to the Top of Mind podcast. If you follow along with Altos Research, you're familiar with our weekly real estate market data video series. With the Top of Mind podcast, we seek to add context to the discussion about what's happening in the market from leaders in the industry. Each week, of course, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand, all the changes in that data, and we make it available to you before you see it in the traditional channels. People really need to know what's happening in the housing market right now, and we're looking at 2025. And so if you need to understand the market and communicate about the market, you should join us at Altos Research. Go to altosresearch.com, book a free consult with our team. Let's review your local market and talk about how to use market data in your business. Okay, without further ado, I'm thrilled to introduce my guest today, Daren Blomquist. Daren is a widely recognized authority in the housing and mortgage industries. He's currently a vice president of market economics at auction.com, where he analyzes and forecasts complex economic data trends, provides unique insights on the housing market, often well before the headlines. Daren's a great follow on social media like LinkedIn. Prior to Auction, Daren was a vice president at Atom Data Solutions, where his research and reports were cited by thousands of media outlets nationwide. Daren's been a guest before on Top of Mind, and I'm really eager to catch up with him today because at Auction, they have some unique insights about buyer demand with investors and about the supply side on the distress side. So Daren has some pretty notable view for home price trends in 2025. So we're going to explore all of that today. Daren, welcome.
Thank you, Mike. Great to be here. Always great to talk to you. And I'm definitely a religious follower of your data that you guys are putting out each week. It's really great stuff and helps. It actually helps. It's a great bellwether for us in terms of determining how our buyers on auction.com marketplace may be viewing the market as well. Because they're looking very closely, not to get ahead of ourselves too much, but our buyers, who are mostly local real estate investors, are looking very closely at the retail housing market and what's going on there. Because even though they're buying distressed properties off of auction.com, they are eventually renovating those properties and putting them back on the retail market. So it's important for them to understand what's going on in the retail market as much ahead as possible, so they can adjust their strategy in terms of buying distressed properties accordingly.
Yeah, and that's such a great place to start because auction is a really neat occupies a really neat space in the housing ecosystem. It is the platform for investors to buy properties, usually ones that went through some foreclosure process or some process like that, where they are now brought to market. So auction, obviously, in the past bubble, there were a ton of foreclosure properties and distressed properties that had to go through and had to be moved and so, like, that was obviously a big component of the market. But in the last few years, we've had record few people in distressed. So talk to me about the overall right now. So you have both sides. You have the distress side on the supply. Mm-hmm. So you have real insight there. But you also have the investor side. And the people who are interested in buying. And of course, demand's been down. So tell me about both sides of your market right now.
Okay, yeah, great. And yeah, we love it. I mean, auction is a really interesting marketplace because you do see that almost real-time interaction between buyers and sellers going on. And granted, it is in the distressed marketplace, but it gives you an idea of what some of these folks who are on the front lines of the housing market are thinking about the housing market. These we call them local community developers. On this, I'll start with the supply side though. That's more the demand side. The supply side, and by the way, our marketplace accounts for about 40 to 50% of the foreclosure auctions that go on nationwide. And those are, when I say foreclosure auctions, those are specifically what some people might call the courthouse auctions or the trustee sales. These traditionally occur at the local courthouse steps in a lot of areas, although very slowly but surely some states are going online with these auctions, which we encourage, and we're all for that, and we see a lot better performance when you have online auction. That's a side note. But so on the supply side, so roughly making up 50% of the market, we're seeing that foreclosure auction volume nationwide is still less than half of what it was back in 2019. We're using 2019 kind of as a benchmark of what was so-called normal market. I don't know if the further we get away from that, the less that may be true. But using 2019 as a benchmark, we're still at more like 40% of pre-pandemic levels or 2019 levels. Not surprisingly, that supply went way down in 2021 when there was a foreclosure moratorium, and it bounced back in 22 and 23. But what was kind of surprising in 24 is we did not see it continuing to climb. It kind of normalized and plateaued at that kind of 40 to 50% level of 2019. And so, and if we were in 2019 right now, people would be saying foreclosures are at a historically low level already at that point. Foreclosures were not an issue, not a problem, not something that a lot of people were talking about in terms of a problem for the housing market. So already a low level, we're at less than half of that. It does vary by state. There are some states that have close to 100% of their pre-pandemic levels, their 2019 levels. They're back to that. And that tends to be a little bit more in the Midwest. And we have some, if you go to auction.com/in the news, I'll plug that a little bit. I do put out a lot of heat maps or on LinkedIn. I follow auction.com or myself on LinkedIn. You'll see heat maps where we show the supply by state, but it tends to be in the Midwest where you see the supply coming back a little bit more. High volume states like California are at about 50% of 2019 levels, Texas about 50%. A couple states that stand out outside of that norm are on the low side are Florida, which is in the 20 percentile, basically almost 80% below 2019 levels. And also New Jersey, New York are kind of in that same bucket. And one thing about those states is all three of those states is they are judicial foreclosure states where the process goes through the courts rather than outside of the courts. And so it does historically tend to be longer. So I'm a little, people sometimes ask, is there this so-called shadow inventory of foreclosures out there? I would generally say no, there's not a huge shadow inventory lurking that's held back. I think there's a little bit of it, and we can talk about that. But I am more concerned about that so-called shadow inventory of distress in states like Florida, New Jersey, New York, where we see these really low levels of foreclosures, and it's almost too good to be true. Some people would tout, at least in Florida, would say, oh, the housing market is so hot in Florida, that's why you have such low foreclosure activity. That may not be so true anymore, right?
Yeah.
But, your numbers probably show that, right?
Yeah. Yeah. So I want to I'm filling up my notebook already. So let's dive into.
We'll pause. Yeah.
This is amazing. So we have less than half of the homes in foreclosure than we did in 2019, and that is generally it's not picking up. We're stable in 2024. So that's an interesting signal by itself. Like even through, we're recording middle of November here. This will be out in a couple of weeks. We have even recently, we're not seeing any real uptick in the number of foreclosures across the country. Is that true? That's
absolutely right.
Okay.
There's nothing, I was just checking our October data. We were at 38% so actually below 40%.
38% as of October.
2019 levels. In terms of, this is specifically the volume of foreclosures that were what we call brought to auction. So the ones that actually went to that auction and either sold to a third-party buyer or went back to the bank.
Okay. So, right, if there was no buyer, then the bank still owns it. They tried it, but they didn't sell it.
Yeah.
Okay. So 38%. And not rising in 2024. So that in itself is a signal for the future. Like there's at least at this point, no national like increase to bank on. However, you said some states are back to their 2019 levels, and those are like the Midwest states.
Yeah, it tend to be in the Midwest, just generally speaking. Places like Indiana is a good example, Oklahoma, where they've been hovering around that level.
Okay. Indiana and Oklahoma. That's interesting. So I was going to ask you if, when you said some of the states are back to normal, or, we'll use air quotes for 2019 as normal.
Yeah.
I do the same thing. It's like it's the handiest, back to normal reference. So when you said there were some states back to normal, I would have assumed that the back to normal would be the same ones that are back to normal on available inventory. So Texas, and Austin in particular, or Florida, or Arizona, those Sunbelt states. But it's actually the states that are still low in inventory. Although Oklahoma's back to 2019 levels. So, but if they're Midwestern states, these are ones that are low in inventory.
Indiana's, this is in the third quarter. Indiana was at 85%. It actually had been closer to 100%.
Okay.
Michigan at 71% is on the high side.
Okay.
Minnesota, 83% is on the high side.
Yeah. So, some of these places like Minnesota, Michigan, Ohio, Illinois, these are states that are just barely above the available inventory of the pandemic levels. So these are restricted inventory states, but they are returning on the distress side. So this is opposite from what I would have guessed. I would have guessed that it's, the people who bought in Austin with a 3% down in June of 22 would have been the ones who are struggling now. That's what I would have guessed. But it doesn't. So can you tell me
I think it actually, on the supply side of foreclosures at this point, it has less to do with the health of the housing market or the health of the economy, which you would guess historically foreclosure rates are very highly correlated to unemployment rates. And so, you would expect what you're saying, but it's more, on the supply side right now, it's more about the process of foreclosure and how the process is how quick it is, how it's done, whether it's judicial or non-judicial, and how the states have approached. One other, not to get maybe too much in the weeds here, but the way the states handled, there was $10 billion during the pandemic set aside to help homeowners avoid foreclosure. It's called the Homeowners Assistance Fund. It's very interesting to look at how each state was allocated a certain amount, and states have widely varied on how much of that they've used. One thing that stands out, Florida was very quick to use their allocated funds there and distribute them more quickly than some of the other states. So it's more stuff like that than I think the actual health of the housing market or economic conditions.
Okay, and now when you say it that way, that makes sense, right? Because everybody's got a job, we're high employment, and people in general, everybody has a lot of equity in their homes and cheap mortgages, which is why in general the foreclosures are low. But there are other reasons why homes go into foreclosure, and you have whatever financial distress, and you have divorces, and you have tax things that don't get, you have these things that happen, and so that are they happen whether or not you have a job, or so those are the things that are dominating, it sounds like, the foreclosure experience now. And if you have a long court process, then those folks are happening slower, and they are less likely to get to a foreclosure process. Is a state like Minnesota non-judicial foreclosure?
I believe Minnesota is judicial. Now you put me on the spot. I think it's judicial.
I don't know.
So that actually breaks the
model. But it's an
model.
interest. But it seems like that must be what's going on, right? So normally, we have less housing activity happening. We have fewer people who are migrating, moving from Minnesota to Texas or to Florida than we did since 2022. That migration is way down, and that's why inventory is building there. But fewer people are selling their houses in Minnesota, and therefore maybe that's a reason that more of those are likely to get into a situation where maybe they're not paying their taxes, and that goes into foreclosure or those kind of things that end up happening. That's a really fascinating trend I had no idea about, and it's opposite of what I would have expected. So that's really, really interesting to know going on right now. So a few states are getting close to the 2019 level. It's the opposite of the inventory states. Tell me about the demand side, the buyer side. I like they're not just investors. They are local community developers. They are people who buying homes, fixing them. They're buying foreclosed homes. They're fixing them in a local market, and they're getting them back on the market for families to live in.
Yeah, and we coined that phrase. I mean, just because there's so much there's a narrative around people, especially buying at foreclosure auction, are the big bad Wall Street investors who are just gobbling up inventory to build a rental empire. I think that may have been more true about 10, 15 years ago. It's definitely not true now. So just a side note, it's like the average distance between our buyers and the properties they buy is about 20 miles. So they're buying mostly in their backyard. Anyway, so they know the market is the point. They know the market very well. A lot of times they've been doing this for decades. So when we look at the demand side, what's interesting is we do see this. It's kind of the flip of this. The supply side, the other side of the coin, is we see the stronger demand in the states where there's less retail inventory. So that there's a definite, in my mind, correlation there between what's going on in the retail market and the demand on the foreclosure side. So our buyers in places like the Midwest, places like the states we talked about, Oklahoma, Indiana, and the Northeast as well, we see demand going up. There's a couple ways we measure demand. One is our sales rate, the percentage of properties available for auction. Pretty simple. It's kind of like the pending rate on the retail side, the available for auction that actually sell, and also what we call price execution, the average winning bid relative to the estimated after repair value of the homes that are being purchased. So looking at those two metrics, those are going up in some of those Midwestern states. There's about 45% of markets in the third quarter where that demand was increasing, and it mostly was Midwest, Northeast. But then across the Sun Belt, Southeast is where you see demand going down at foreclosure auctions specifically. Now, overall, because of the Southeast and Sun Belt make up a lot of the volume, we do see demand going down if you look at it at a national level. Those demand metrics going down, and they really turned a corner in about May or June of this year, which I think is, if you look at retail inventory, that's around when that kind of turned a corner and started ramping up. And I don't want to you know this better than I do, but it might be over exaggerating it to say that it ramped up, but we do see retail inventory rising.
Oh yeah.
And so we do see our buyers in general nationwide. Of course, there's a lot of local nuance. Getting more conservative in how much they bid, and also shrinking their buy box and maybe buying fewer properties. And that shift occurred in May, and it's gone all the way through October. Those trends have just continued to go down. It'll be interesting to see what November looks like, given the election. Is that when we survey our buyers, back in September, a lot of them were saying they were just kind of waiting on the sidelines for the election to happen. to achieve some certainty. But yeah, on the demand side, that's the big national trend is coming down, but we do see like a good percentage of markets where demand's going up, and it tends to be where there's less retail inventory available.
Okay. And so you called it the sales rate as your sort of barometer of demand?
Yeah.
And do you have a national number on that we can use?
Yeah, it's around 52% right now as of October. And now
great.
I should say, to put this in context, to go back to 2019, there's been a paradigm shift in that demand. Like if you went back to 2015 through 2019, the average sales rate was more like 38%. And we're at 52%. So when I say demand has come down, it came down from a peak of earlier this year, more like, 50, 55, 56%. So we are coming down, but we're still way actually above those 2019 levels.
And is that because we still have less retail inventory? Therefore we sell through more on the foreclosures?
Yeah, I think that's part of the water that we're swimming in. Is there's not a lot of inventory out there for these investors to purchase, and on a side note, again, we're seeing actually an increase in owner-occupant buyers using our platform, which is interesting. And the theory there is they may have just gotten frustrated with the retail market and are turning to other sources. So yeah, that's I think a lot of why there's this higher level of demand than we.
Oh, right. These are not just investors now. Now there's suddenly some first-time home buyers who are like, well, this is a way to get into the market, maybe at a lower price, a house hack kind of purchase.
Yeah. We just dropped we do a video series called Disposition Download on auction.com in the news. It's a fun one, and we interview some of these buyers sometimes. And we just dropped one where a owner-occupant buyer story in Aptos, California, bought a property.
In what town?
Aptos.
In Aptos, down by Santa Cruz. Okay.
Yeah, Santa Cruz. So he has a nice oceanfront condo that he bought. So anyway, he actually bought several years ago, but we're seeing more of those buyers who at least tell us that they're owner-occupant buyers.
Yeah. That's really cool. That's a fascinating trend. There's a lot of really neat trends going on right now. So the sales rate at 52% right now is actually higher than 2019, but the dynamics are so different. Before we had a lot more retail inventory and a lot more distressed inventory. We have half the distressed inventory, so you could imagine that the sales rate would be higher now. We have. Do you know off the top of your head the 2023 sales rate? Like the first half of 23 was surprising in the demand, and I noticed it in places like Phoenix. Phoenix prices tanked really quickly in 22, but I noticed a floor on prices, which I attributed maybe to investors with cash kind of keeping a floor on prices, and so home prices fell, year over year in the first quarter of 23, but then rebounded surprisingly quickly at the second half of 23. Did your sales rate correlate with that at all?
Yeah, I'm just looking here. I mean, I'm looking at the national numbers, but we definitely saw the sales rate plunge in the second half of 22, which is probably not surprising. But it did start picking up around February, March of 2023, and it got up to, it recovered. It was basically the second half of the year until the last couple of months of the year. It was around 55%.
That's
where it had
really
gotten,
great.
In late 2022, it had gotten as low as 45% at the end of 2022.
Got it. And so that actually correlates with the same pattern that our price reductions number followed, which is, we could see the weakness in the fourth quarter, 22. Then the headline sales prices had their dip 6 months later in, March, April, May of 22. But by then we could see recovery in our price reductions and in your sales rate, which sort of foreshadowed price stability for the rest of 23, we could already see it turning the corner in February of that year.
That's right.
That's really interesting. Okay,
Yeah.
that's good. So, but then fourth quarter 23, we had mortgage rates spike again, big demand drop, and then and so it backed off again to set us up for a weaker 24.
Yeah, I mean, our buyers were as I said, the big shift we saw in 24 was around April, May, June. Really, June was when we really saw it shift.
You saw weakest demand around June of this year.
Well, it started shifting downward, and it's continued to shift downward since June. In terms of both the sales rate has stabilized a little bit, but that what we call winning bid to after repair value, our buyers are saying, we think there's extra risk in the market, and so we want to bake that into our purchase price, our margins up front, and so that winning bid to value ratio was up around 61% back in April, and it's come down to 54%. And I do want to just make a note on that. It doesn't mean that these people are buying at 46% below market value. These properties are highly distressed, so that's relative to what we call after repair value, which I'm sure you know. But just to set expectations there, you're not getting a 46%, 40 to 50% discount necessarily off of the as-is value of the home. You have to put a lot of work into that once you buy the property to get it to that after repair value.
Right. That's the whole point of buying
the
distressed property.
Yeah.
And even if you're an owner occupied, right? That's the point. I'm doing it because I want to do the work. I want to get the sweat equity into it and make the return.
That's right.
Okay, so that's really interesting on the trends and on the data that you guys see. It's great. It's both of the supply and demand side is really a neat view, and it's nice to know that it correlates roughly with especially the leading indicators that we see here. So I want to shift gears. There are two big things we want to talk about. First is that while we're talking about the pace of foreclosures and that some of the judicial states, have fewer in the foreclosure pipeline, as much as 80% fewer homes in the foreclosure process than normal. There is something that you and I discussed just briefly that I think you might have an opinion on. And I have had a few folks reach out to me, and these are folks who may be like running a big hedge fund, or they may be like a, investor on the ground, boots on the ground kind of guy who buys properties or buys bad debt in Phoenix. Both ends of the ecosystem. I had multiple people say to me, Mike, there are government programs happening now that are preventing foreclosures, and we're putting people back into, we're doing a workout or a forbearance thing, and we're putting people back into a cycle where they are taking them out of their distressed property, and we're resetting the clock, and they're not showing up on the distressed, the stats, because they are worked out and they're not late on their mortgage anymore. And
right.
but then we see it happening multiple times to the same property.
Yep.
Can you help me understand this? Is this a thing that I should care about? Is it a thing that's real? Is it a thing I should care about? What's going on? What's the value? Help me.
Yeah. Sure. Yeah. And I would say it is a real thing. And we a lot of our clients have mentioned this. Not so much, our clients are the servicers. They're seeing those properties recycle, into loss mitigation, out of loss mitigation, back into loss mitigation. And so we heard about this, so we started looking at some of the data that we had access to, which is our own data. And we came up with something that I call the foreclosure spin cycle, where there is I looked at about 400 I'm just looking at the numbers here, 400,000 properties scheduled for auction between 2019 and 2023. And then just looking at how many of those were scheduled multiple times. In other words, they got scheduled for a foreclosure auction, the auction was canceled for some reason or postponed, but then they came back and were scheduled again multiple times. And about 150,000 of those were in that bucket. So about, a little over a third of these properties are at least cycling in and out multiple times. And so it's a real thing. And we are seeing that the number of times they're scheduled has gone up. It's not a dramatic shift, but from about three times scheduled on average among those multiple scheduled to now about 4 times. What's more dramatic is the average time they're sitting between the first time they were scheduled for auction and the most recent time they were scheduled for auction. Back in 2019, it was about 188 days between those two. Now it's up to 479 days. So it's gone up dramatically in terms of the time that these properties are kind of sitting in you might call foreclosure limbo or this foreclosure spin cycle. And so yes, that it's a real thing. And it is a concern. Now, I don't think this necessarily means there's this huge shadow inventory of foreclosures because we're at such a low level already. Even if all of these suddenly came on the market or hit foreclosure, you probably wouldn't even see numbers back to 2019 levels.
Right. Okay.
So,
but 150,000 that you've seen go 3 or 4 times through we're not making our mortgage payment, we get into the distress cycle, delinquent 30, 60, 90 days, we're scheduled for auction, some kind of workout happens. They're brought current or renegotiate their current, and then so 3 or 4 times you see the same property go through that cycle, and that's therefore now those folks are 479 days since you saw it the first time is
right.
Roughly what we're looking at here, and it's 150,000 of those.
Yeah, and that's just on the auction.com platform. That's not
right.
That's not the full market.
But of the 400,000 that went through, 150,000 of them were in this. Is it a CFPB? Is that who's leading the workout? Like, is there a specific program
that's part of it? The CFPB has been very proactive in encouraging servicers to make sure they give borrowers every opportunity possible to avoid foreclosure. And then related to that is during the pandemic, the loss mitigation waterfall that came out of really the pandemic was much more aggressive in trying to help homeowners avoid foreclosure. And so it's been, there's the regulatory side with the CFPB. You look at programs put out by some of the government agencies, Fannie, Freddie, FHA. They've rolled out these loss mitigation options that were never available before the pandemic, or at least not widely used. So the FHA, one of the big ones is the partial claim, using what's called a partial claim to basically take your back payments that you've missed and put them on the end of the loan as a second loan, non-interest bearing loan that gets paid off when you eventually sell the property. So that's, and Fannie and Freddie have a similar kind of payment deferral. So you've seen this combination of things. I would say it's all the underpinning of a lot of this functionally working is the fact that homeowners have a lot of equity. And so these programs can work and be effective because many homeowners, even who are in trouble, have a lot of equity in their homes. And so they're able to leverage some of these programs to avoid foreclosure.
Okay, right. So if I'm 90 days behind and I take that and I put those payments on the end of my loan and now I'm current again, it's okay because I'm 63% loan to value instead of 60% loan to value, and it's like still a pretty safe loan
Right,
in that
exactly.
mess. That's an interesting thing. So it's not just an aggressive regulatory environment. The actual market conditions allow for this to happen. It's one of the impacts of having such massive equity is that
right.
these workouts can happen. And in 2008, 25% of the country is upside down, and you can't do it. You can't do this. Like, this kind of thing is not available. Okay,
That's right.
That's really helpful to me. But 3 to 4 times through the spin cycle seems like, the way that the investor colleague in Arizona mentioned it to me. He's like, these people are never going to make this loan payment. Yeah, and they're saying to me, I'm never going to make this loan payment, but like they keep going back in. So that 3 to 4 times seems maybe problematic. And do you have an opinion on that? It's really hard.
I do.
It's really hard to say, we should be foreclosing on more homes. Like, that's a real hard opinion to
Right.
take.
Yeah, that is. But I think there is a line where it becomes actually counterproductive to the market, but even counterproductive for the homeowner who's in the home. I don't know exactly where that line is, but there is a point where they're actually, through this process, they're losing equity over time. They have this equity, but they are leveraging that equity to avoid foreclosure and losing equity. And there's a point where they would have been able to sell early on and get a lot more equity than if they sold later on. And some people would say, well, that's a fair trade-off because they're getting a place to live for 479 days extra. So I think that's a healthy debate to have for sure. But I think there is a line, and I think we're close, if not have crossed that line in terms of where it becomes counterproductive and actually harmful to the homeowners, harmful to the market. I mean, the other thing with these properties is they tend to be falling into more disrepair over those 479 days. And so the neighbors around that home are impacted, is one piece. And then another piece you could argue is this paradigm shift in the way that we do loss mitigation / foreclosure is restricting the supply of affordable housing out there. Now, of course, there's a percentage of these properties that are vacant, and so to me, that's a no-brainer. Those should be pushed through. But even the occupied ones, it's a harder conversation because then it does involve someone losing their home, but there is an opportunity there to get a new person in that home who can afford it and will maintain the home, which will help the neighborhood. And these homes, even they tend to be on the lower side in terms of pricing and more affordable. So those would be some arguments I would throw out there as to why there should be a line as to how long we allow or just keep putting people through the foreclosure spin cycle over and over again. And actually, I talked briefly to Mark McCardle, and this was in a public format. Mark McCardle over at the CFPB just yesterday, but and he sees that. I think, of course, the CFPB will probably be changing in terms of how it stands toward regulation. I think he even acknowledges that they are formulating a rule, a loss mitigation rule, to kind of put in place some of the learnings from the pandemic. And they want to keep around a lot of the practices and strategies that were used by servicers to help people avoid foreclosure. But even I think there was some acknowledgement on his part is that there is a point where it becomes too much,
Right?
And you do need, and there is a necessary foreclosure that needs to happen. That is not, of course, the optimal situation. When a bank originates a loan, they don't want that to end up in foreclosure. Nobody really does, but there's a point where that becomes necessary, and then actually it can become beneficial to the surrounding neighborhood, to the homeowner. One thing that I think a lot of people don't know is when a property sells at foreclosure sale for a foreclosure auction, if it sells below the debt owed to the bank, that surplus amount does not go back to the bank. It goes to the homeowner. And we're in an environment right now because of the hot housing market where we're seeing a lot more properties sell with these so-called surplus funds that go back. So the homeowner can walk. It's not like their equity is lost. They are losing the home, but they're walking away with equity to show for that. It's kind of a protection at the end of the line. If they don't decide to sell before foreclosure, at least at that foreclosure auction, they can walk away with that equity.
They get a little bit of the equity. Well, and just to put a bow on that topic, we talked earlier about the judicial versus non-judicial foreclosure states, and the non-judicial foreclosure states are like, you missed your payment for 90 days and it's courthouse steps, and we could see, in the bubble burst and the recovery, the states like Arizona, the mostly southern western states that have the non-judicial foreclosure markets recovered. Those markets recovered in 2010. 2011 was obvious recovery, where in New Jersey you had 4 years of foreclosure court, and so it wasn't until 2015 before some of those markets finally recovered, and people, because that process clears it out and it starts people who can't afford it in a refresh, and so it was, the point of judicial foreclosure laws is so that the big bad bank can't kick somebody out of their house, and you can understand that is a worthy goal, and there have been plenty of examples of servicers over time who screwed up and kick people out they shouldn't have. There was some real challenges there. So you can understand a point of having a court there. But I can also point that the ones that don't have that long, multi-year, drawn-out foreclosure process definitely recover faster from the downturns.
Yeah, absolutely. Yeah, that's. I think the data is pretty clear on that. Especially looking back to the foreclosure crisis downturn, the recovery was much faster in the states that were able to process the foreclosures faster.
That was terrific. That's exactly what I needed to understand about the foreclosure spin cycle.
Awesome.
It'll be really interesting, and I hope maybe I could get you to if we watch that 150,000 number climbing, or those 3 go to 4 to 5 or 6 schedule in there, if we see that happening, or if maybe we have a new administration that guts the CFPB and maybe it doesn't happen anymore at all, and we see what happens on that side. It'll be really fascinating. So hopefully we'll check in on that trend.
Sure.
It's not, though, notably big enough really to move the needle on the distressed inventory. Not really big enough to because there's legitimately not that many people distressed, even the ones that are in this spin cycle. Okay, I appreciate that, because I had big servicer hedge fund guy who thought it was significant. I was like, I'm going to find the data on it for you. Okay, so that's great. Let's switch to the other big topic that I want to make sure I get from you today, and that is that you have a pretty bearish view for home prices for the next 2 years. Or at least in the last time that we do this survey together with this company Pulsenomics for Fannie Mae, where they poll 100, they survey 100 of us who look at home prices and data for a living. And so you had one of the more bearish views, in a view that said you're thinking home prices probably dip in 25 and again in 26. Will you let me know is that still true? And also let me hear your argument on why you think that we are maybe in a risky point for home prices.
Yeah, I mean, that is still generally true, although I think I just got the email that it's time to
do next quarter. I know I did too.
My next quarter responses. But I haven't sat down and really plugged in the numbers. But generally, yes. I mean, I do tend to think that there will be a slight correction in home prices over the next couple of years. And I know that's counter to a lot of what people are thinking. And I definitely am open to being wrong there. And in fact, I would say we're planning our business at auction.com that the market will keep going up, because that's a more conservative approach for us. If home prices go down, that actually would probably result in more foreclosures. But we're not counting on that to happen necessarily as a company. But personally, when I look at a couple things I think that color this mostly are, number one is what we've already talked about a little bit is some of the signals I see in our buyer behavior that signals uncertainty in the market going into 2025 and uncertainty in price stability into 2025. And then the other one that's a little bit more data-based is just looking at the historical price-to-income ratios that have become extremely disconnected, especially starting around 2021 and have continued. So if you look at that price-to-income ratio of, depending on how you look at it, but the way I would calculate it is what home prices, quote unquote, should be if we had traditional historic price-to-income ratios, are about 20% still below what prices actually are. So there's this 20% delta. Now, that doesn't mean all of that is made up by a price correction. That could be made up by not lower mortgage rates, because that's not part of the price-to-income piece, but it could be made up by
higher income.
Higher incomes, yeah. So incomes increasing faster than home prices, or some combination of that, or home prices decreasing. But
so you're looking at affordability, which is obviously strained, and you're measuring it with a price-to-income ratio, and not including mortgage rates, just looking at the price of the home and the income. And by looking at that long-term trend, you see that incomes are 20% below normal.
Well, prices are actual home prices, and this is just at a national level.
Yeah.
Actual home prices are about 20% above, I'll put it the other way, above what they quote unquote should be if we had normal price to income ratios.
Right.
And I think the tendency is, if you look back historically, you're very rarely right on that historical average price to income line. But when we go above it, like we did back in 2006, 2007, we tend to revert back to the mean, and actually probably overcorrect. So I do see us moving back toward that historical home price to income trend. I mean, I think a big argument against that is that we're still supply constrained,
right,
and that is keeping kind of this unaffordable environment.
Yeah, and that's where I would have gone. And looking back at 2007, our data was really early for us, but we had some of the data at that time, and we could really see the ones who overcorrected on the way down were oversupplied, and we could do it as a inventory per capita or people per available home. And so when we look at that as a metric, we could see that markets can stay unaffordable for a long time, given that given a tight inventory per capita. However, though, we have some markets in the country which are back to 2019 levels of supply, and some like Austin, which is at 15-year highs of supply. So,
what's your view? Do you have a view on?
So
I need to go back and look at your results on the survey.
Yeah. Well, my view for 2025 is that one way to think about it is normal for home prices is about a 5% appreciation. is normal for the U.S. And that's because of generally growing economy, generally growing population, underbuilding, like chronic underbuilding. And so as a result, but over the last, decades, it's about 5%. We've had 5 years total of home price declines or something like that in the last, if you look at like the Case-Shiller data over 80 years, we've like 5 years that have had home price outright down years, something like that. So my baseline starts at 5%, and then you go, okay, but we have affordability challenges, we have rising inventory, we have maybe shifting like unemployment things, we probably have negative immigration, so we probably have several factors in 2025 that pull out of that. And so I'm looking at, and by the way, we're doing a Housing Wire forecast paper, which will be available right about the same time as this for Housing Wire subscribers. You can go get our full forecast where we dive all of both pricing and the supply numbers. That'll be available on housingwire.com, where we do all this logic. But that leads us to believe that we'll be underperform the long-term trend in 25. But, long-term trend is 5% up. So we don't see the broad negative, like shift it to, price declines in the immediate term. That's the way we're looking at it. So we're forecasting at about, I think, 3.5% home price gains for 2025. The affordability challenge is real, and it is dramatic, has dramatically reduced the number of people who can buy homes, but we have fewer homes available. What else do we have? We also have, interest rates have stayed higher for longer than anybody expected. And that's really impacted the total transaction volume, but has not really impacted the prices, with a few local exceptions.
I mean, certainly price appreciation has slowed down, right?
Yes.
Overall. But, I mean, if you look at the NAR numbers, we did have a slight correction in home prices in 23? Yeah, 23.
Yeah, for a few months in 2023, they were
Not
negative.
for the whole year, to your point,
Right.
but there was a few months that we dipped below. We went negative. Yeah.
That's right. We did. And that's when I mentioned it earlier, we were talking about your demand indicators that you have in your data. We could see by the time those sales prices were down in the second quarter of 23, we saw the leading indicators in our data and in your data had already ticked up, and that ended up as a positive year, which surprised the hell out of me. Like, I was not expecting 23 to be positive, given how catastrophic the end of 22 was. And so,
the market has been amazingly resilient given the shock of the mortgage rate rise increase back in 23.
One of the things you mentioned on that side was that it seems like now in the fourth quarter of 24, your investors your demand from your local community developers are decreasing and continuing to decrease. And one hypothesis I have, and I don't have any data on it, is that a lot of folks had pandemic cash on hand, and that's starting to, and they could deploy it into things like buying a $130,000 foreclosure house and putting some capital into it. But maybe that cash is drying up a little bit. Do you have any insight on that?
Yeah, I haven't heard that from our buyers specifically. I'm not that it couldn't be true. But when we surveyed them a couple of months ago, the election was something that came up. But the number one reason they said that they considered the market a headwind to them buying more properties from auction.com or on auction.com was pricing. They price even at the discount they're getting on the distressed discount. They consider that both acquisition and rehab costs going up was their number one reason
Yes.
for
Okay. So not
pulling
just the
back.
price of the house, but the impact of the of 3 years of inflation on washing machines and things like that.
Yeah,
And structure. Okay, that's an interesting. And those are real signals, and I think those are help me be keep the radar up for affordability signals and see if those are like, is that sufficiently weakening demand that drives pricing down in the next year? I will be watching for that. That's really great.
Yeah.
And so that
No, I mean, we can. I think it's a healthy debate, and I think there's really good evidence on the other side of things too.
That's great. And,
So,
and that was
and really, I've been surprised by the market over the last few years in terms of how resilient it is. So I
Yeah.
could be surprised again.
Yeah, and I've been generally, I thought earlier this year, like you mentioned in the June, May, June was looking really rough, and I was assuming that was going to bring home prices down by the fourth quarter, and we haven't really seen that happen. So I was a little too pessimistic again on prices, and I was probably optimistic on home sales volume growth. So that's a really those are where the surprises came in. So that, by the way, is data that was in your auction market dispatch report. Is that right? Like people can go get that?
That's right. Yeah, you can Google auction market dispatch. We're doing that quarterly, or look it up on our auction.com /in the news section. You'll find that as well. So yeah, thanks for that.
And you've got some product announcements happening in auction. Is it time to tease that? Do you want to get that out? Like this, we're going to air in a couple of weeks still. So
not unfortunately not quite yet.
Okay,
but yeah,
trying to get the scoop.
Yeah, I would say we're definitely looking at. I think we're at an inflection point. Several inflection points in the broader market that lend themselves to opportunities and continuing what auction.com has been about since the beginning, which is kind of disrupting the distressed marketplace. and so that's what we're looking at, is ways to continue to do that. We did that back in 2012 was when we entered the foreclosure auction marketplace. Before that, most properties that went to foreclosure auction, I talk about that sales rate now being at 52%. It was more like, back before auction.com came into the marketplace, it was more like 20% or less than 20%. 80% of properties went back to the bank, became REOs. We came in and said, hey, this is actually an opportunity it's not just a checkbox to get the property back to the bank. It's an opportunity to sell the property. It takes risk away from the bank but it also does a lot of other things. Gets these properties back into the retail marketplace faster, and it provides those surplus funds that I mentioned earlier for the homeowner. Like if there is equity in that property, at least that homeowner can get that equity. Whereas if it goes REO, if the bank then turns around and sells it for more than what was owed, the bank gets all those surplus funds.
Right.
Doesn't go back to the homeowner. So
it's an efficiency thing for everybody in the market, and that's really before, when you did the auction on the courthouse steps, it's whoever's standing there on the other side and wants to bid on that at that moment is that's the audience. It reaches a much
so
bigger audience.
we've definitely tried to broaden that audience, so it's actually a true marketplace, competitive, transparent marketplace, and we're looking to continue to do that.
That's terrific. Daren Blomquist, we've blown through an hour already.
Wow.
It's a really great conversation. I appreciate your insights and your data so much. You helped me dial in my expectations on home prices and the things that I'm looking for. So those signals are really terrific. Everybody, Daren Blomquist, he posts a lot of great stuff on LinkedIn, but also at auction.com/in-the-news is where all that data comes out. Look for the auction market dispatch report. Anything else we want to make sure people pay attention to, Daren?
I think that covers it. I really appreciate the time and the opportunity, Mike.
That's terrific. All right, everybody, this is the Top of Mind podcast. I'm Mike Simonsen. Thank you for joining us. If you enjoy the podcast, I really appreciate a review, some 5 stars on your podcast apps, because that helps other people find us and share the really insights about the housing market from folks like Daren. So thanks, everybody. Thanks, Daren.